Welcome to our CFP exam prep discussion on estate planning, specifically focusing on marital and charitable deductions. Today, we'll dive deep into one of the most frequently tested areas that many candidates struggle with. Let's start with the concept of unlimited marital deduction. This powerful estate planning tool allows unlimited property transfers between spouses without triggering any federal estate or gift tax. Think of it as a complete tax shelter for spousal transfers. However, there's an important catch that often appears in exam questions. The receiving spouse must be a U.S. citizen for the unlimited marital deduction to apply. If your spouse is not a U.S. citizen, different rules apply, and you'll need to use a qualified domestic trust or QDOT to achieve similar benefits. A common mistake students make on the exam is assuming that all property transfers to a spouse automatically qualify for the marital deduction. The property must be considered qualifying property. For example, if you give your spouse a terminable interest in property, meaning an interest that will end after a certain period or upon a specific event, it typically won't qualify for the marital deduction. Moving on to charitable deductions, the IRS allows unlimited deductions for transfers to qualified charities during life or at death. The key word here is qualified. The exam frequently tests your ability to identify what constitutes a qualified charitable organization. These typically include religious organizations, educational institutions, and organizations that have received 501c3 status from the IRS. Here's a practical example that often appears in exam questions. Imagine a client wants to leave $1 million to their spouse and $500,000 to their alma mater in their will. Both transfers would qualify for unlimited deductions, resulting in zero estate tax on these specific transfers. However, if the spouse is not a U.S. citizen and no QDOT is established, only the charitable portion would receive the unlimited deduction. Let's break down the main concept of QDOTs since it's a frequent exam topic. A QDOT must have at least one U.S. trustee, and any distribution of principal from the trust is subject to estate tax unless due to hardship. The exam might try to trick you by presenting scenarios where a non-citizen spouse receives property directly, asking you to identify the tax implications. Another area where test takers often stumble is with partial interest gifts to charities. If a client donates a remainder interest in property to a qualified charity, while retaining a life estate, specific requirements must be met for the gift to qualify for the charitable deduction. The exam might present scenarios where these requirements aren't met, expecting you to identify why the deduction would be denied. Remember this key point for the exam. While both marital and charitable deductions are unlimited, they serve different purposes. The marital deduction essentially postpones estate tax until the death of the surviving spouse, while the charitable deduction permanently removes assets from the taxable estate. Before we wrap up, here's a quick review tip. When you see an exam question involving transfers to spouses or charities, always check three things. First, is the spouse a U.S. citizen? Second, is the charitable organization qualified? And third, is the property interest being transferred qualifying property? These three checkpoints will help you navigate most related exam questions successfully. Understanding these deductions is crucial not just for the exam, but for your future practice as a financial planner, as they form the foundation of many estate planning strategies.